This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com, and I have with me again this morning John Rubino, well-known author and publisher of the website $collapse.com. Good morning, John. Welcome back to Macro Analytics.
Good morning, Gord. How are you?
How quickly the month goes, doesn't it?
It does fly by. Well, you know, it's such an uneventful world out there. I'm surprised the time does fly by, you know, because nothing's really happening anymore.
Exactly. I do slides, and I just barely get them done, and they need to be changed again because their changes are so dramatic. I need to make a point here, John, to our listeners. The slides that we're going to show today are for discussion and educational purposes only. Do not trade from any of these charts. John and I are not giving investment advice, nor should it be construed as such, and always consult a professional investment advisor before making any investment decisions. Our subject today is the Dow 20,000 or 5,000, which one, and as importantly, when. So that's the question I'm going to put to you to kick this off. What do you think is going to happen?
Well, I think we're at an inflection point, but I'm not sure what the inflection point is. You know, we have two sets of really powerful forces out there that point in completely opposite directions for the stock market. Let's start with margin debt as a really good indicator of a market peak. You know, the margin debt is people borrowing against stocks to buy more stocks. It's a sign of enthusiasm. And when it reaches a very high level, that means everybody who could possibly be borrowing against their stocks are pretty much doing it, and the market is ready for a hard correction. And we've seen this happen twice in recent times, once in 2000, once in 2007, when margin debt really peaked, and then the stock market tanked after that. Now, we're at the same point again here. The first chart that covers margin debt shows what happened through September, when margin debt spiked to near record levels. And then I think the next chart we have shows what it did in the last month. So we have...
And that's called taper delay, and everybody's yelled, including Bill Gross over at PIMCO, yelled immediately, risk on.
Yeah, because now we basically accept that the Fed is not going to slow down its asset purchases anytime soon, at least for a few months. And you and I think it's going to be forever, but the market in general thinks a few months, which buys a little more time, a little bit more liquidity flowing into the market, and makes stocks a little bit less risky at the margin. So people have decided to buy even more stocks on margin in the last month, and so we've seen margin debt spike to very close to the record level that it hit in 2007. So that, if you're just looking at history, expecting it to repeat, indicates a major correction imminent. Okay, it might not be this month, it might be a few more months, but when it comes, it'll be big, and the downside risk in the stock market is dramatically higher than the upside potential right now, just based on history. And we have one more chart, I think, right? That shows the credit balances of investors out there. And this is a variation of margin debt. It shows whether people have free cash in their accounts or have used their accounts to borrow against stocks. And it is now reaching 2000 levels when people were insanely exuberant about tech stocks. So that's another indicator of market fragility and an imminent correction.
It says that people believe this is a sure thing. This is a sure bet. It was like, I remember the fall of 1999. Technology and the internet and the impact was a sure bet, just before it totally collapsed on everybody.
Mm-hmm.
And took us 4 or 5 years to come out of it before we went through the next bubble. Clearly, this is a little alarming, to say the least. But that doesn't mean that we're going to see a significant correction. We could see a consolidation, which is going to scare the bejesus out of everybody. But
yeah, well, it doesn't necessarily mean everything because history doesn't always repeat perfectly. And so the question now is, are we America in 2007 or 2000, or are we Zimbabwe in 2004, 2005? Because that country was embarking on an epic hyperinflation at the time, and its stock markets went up by about 1,000% in 1 year. And presumably all the indicators that you and I just talked about, all the leverage indicators and all the sentiment indicators were screaming sell at that point because the market had just blown through previous records in just a very short amount of time. And yet the Zimbabwe stock market in the next 3 years went from 40-something thousand to 4 million. It went parabolic. And that was because they were in the process of destroying their currency. Nobody wanted to hold Zimbabwe dollars anymore, so they were looking around to buy anything real. And the stocks of companies with real assets are themselves real assets. So they tend to go up in times of dramatic inflation. And that's what happened in the Zimbabwe market. And so the question is, are we heading into a period like that? Because we are flooding the system with cash, where we're making on a slightly smaller scale the same kind of mistakes that Zimbabwe made. And at some point, if our trends continue, then we end up like that. So is that what's happening now? With the global stock markets all melding up at the same time, and is what's happening going to make invalid the technical indicators that we tend to use for measuring the stock market in the short run? So it's an interesting intellectual exercise with a lot riding on it, because what you do with your money should be very different in these two scenarios. And so the question is, which are we in?
I think we got quite a number of other proof points that can help us answer that question. Maybe not conclusively, but certainly give us some very strong indicators, because Zimbabwe wasn't the only one that has went through something like this. I've got up this chart of Venezuela. This one is showing when it started to really lift back through, later into 2010, and it was like quite alarming. But it was nothing compared to the next chart showing more recently in Caracas, it went absolutely parabolic. Now, what is so positive about the Venezuelan economy? The answer is nothing. The answer is actually in what you just said, John. It's the only way to protect your wealth is to put it into companies that have real brick and mortar or a real free cash flow access, or at least it's perceived relative to other places to hide and store value. There's no way to store value of your money. That's the perception.
Venezuela is in the process of creating way too much currency and destroying their currency. And so the market is up 300% year to date so far this year. It's vastly better performing than the U.S. stock market. But like you said, it's not for good things going on in the economy. It's because people are losing faith in the currency. And this is the classic Austrian crack-up boom. It's not a case of too much currency being created. It's not a supply problem. It's a perception problem. Everyone loses faith in the currency. They no longer want to hold it. And so the demand for the currency goes through the floor. And the prices of everything that you can buy with that currency go through the roof when denominated in that currency. So it's not like things get more valuable. It's that the currency becomes less valuable, but it manifests as hyperinflation. And so we saw it in Zimbabwe. We're seeing it in Venezuela. And it would be incredibly arrogant for the developed world to think that they can basically make the same mistakes and not have the same outcome at some point. So, again, the question is that what we see now? Is that what's coming? Or do we get a pretty serious stock market correction, which leads to even more extreme policy mistakes, which then gives us the crack-up boom?
History tells us that's what we should expect, that it forces more policy decisions, and the policy decisions become one and the same. The only solution is the printing press or the exponential creation of credit, because anything else immediately puts you into a serious contraction, unemployment, recession, and you have problems at the polls, election. Because we saw in Europe, as soon as you even suggest changes such as austerity, the reaction from the public is just unacceptable. You're out of power.
Yeah.
John, you made another good point too. I'd like to echo is when you get these crack-up booms. I did a series with Ty Andros on hyperinflation, and on the 54 documented examples of hyperinflation, they all were a currency event. And as you said, prices go up, but it's because there's a lack of trust, a flight on the currencies. There in itself, as the currencies are debased, prices of assets go up. But it all depends on which assets to flight to quality will occur in. And the other thing that was very clear is once it begins, it has a very short life cycle. And a lot of those 54 were measured in weeks, days, or few months. Very few of them extended out 6, 10, or 15 months. So once it begins, the blow-off is short-lived. So in our case, this could be a blow-off and it ends in 2014, if history is any indication. And in fact, what we really have is a debasement of global currencies.
Yeah, I like your idea that we get a serious stock market correction in the short run, and that's the catalyst for the really big blow-off quantitative easing increase that they would have to come up with if they were afraid the economy was going to tip over into a recession at this point.
Our charts, John, suggest that we're very near an intermediate fear and correction, which should be viewed as a consolidation, that will be one more wave to come, but only based on that we have a global, coordinated intervention where we increase the amount of credit growth. Think of it as next round of quantitative easing, Yellen's new special plan, whatever. And I'm sure it's more than a coincidence that she's been chosen. That will be the cover to increase, because right now we've reached a point where actually the credit growth is not sufficient. We're running out of runway on that. And I have a little formula that will show you that.
And if they bump QE up to, let's say, $150 billion a month. We're talking astoundingly large numbers at that point. And that money will flow into bank balance sheets, and excess bank credit will go through the roof. And at some point, if that starts being lent out, we're talking trillions of dollars of new loans hitting the system in a very short period of time. So things can get very crazy very quickly with this much money just sitting on the sidelines now, and this much new money flowing in. So instability is probably the most reasonable prediction. We don't know whether it's going to be down or up, but clearly this much money is going to lead to some kind of extreme instability in the not too distant future.
Precisely.
Catherine Austin-Fitts has an interesting angle on this subject, and you've interviewed her before, and she talks about the breakaway civilization that is basically the 1%, technologically sophisticated, very rich, and is consciously sucking wealth out of the 99% right now. And her thesis is that the next stage in that process is a global debt for equity swap, in which they engineer a massive increase in stock prices as a way of dealing with the debt that we've taken on. So that fits this paradigm here, that on the one hand, maybe it's happening kind of unconsciously. We're just lurching into a crack-up boom. And on the other hand, maybe the people in charge are planning it. But either way, the result is the same for the rest of us. We see equity prices just go through the roof because nobody wants to hold dollars anymore. And that's something that, we've had stock market booms for the last few years. Or for the last few decades. We've lived with big bull markets that then bust. But this is orders of magnitude more extreme, what we're talking about here. In a Zimbabwe or a Venezuela scenario. So it's something that despite the fact that we've lived through the tech stock bubble and the housing bubble, we're not really prepared for this. So it'll be fascinating to see how it plays out.
John, I mentioned that formula. One of the things that I'm watching very closely is the amount of credit growth and the amount of liquidity. We've had in the United States the budget being reduced. We're down to about, this year the current run rate is about a $600 billion budget deficit, which is about $50 billion a month. And quantitative easing is still running at $85 billion. And we have a negative current account of minus 40. So that's right now, they're about equal, pretty close to equal. So this excess liquidity that we've had that has been driving the market, and the perception is actually starting to be compressed, which I think is one of the things that's going to trigger a consolidation or a correction. But that will be quickly alleviated, not because we won't spend on the budget and not because the current account is actually not going to get worse. We're going to see quantitative easing 5 or 4 plus have to come out to keep this machine going. Otherwise, we're going to have an implosion.
The economy is acting like monetary policy is actually pretty tight, because you see a plateauing and a slowing down of a lot of big indicators. And one of them that I just saw this morning that's really interesting is that non-participants in the labor market just hit an all-time high. There are 90 million people over the age of 16 in the U.S. who aren't in the labor force. They're either not working or not looking for work or whatever, and that's the highest it's ever been. And that's the sign of an economy that's not accelerating, because we would be sucking people into the workforce, and you'd see people outside the workforce as a percent of the economy dropping dramatically right now. But that's not happening. The opposite is happening, which implies a slowdown. And they can't let that happen. So if the slowdown hits the stock market, as you said, that's going to be the excuse for a massive increase in new money creation on the part of the Fed.
We've been papering over the fact, you and I talked about a stealth depression here over a year ago. That I think they're afraid of the big R word. All the numbers I see, we're very much in a slowdown, and we have the potential of a recession. And if we have a poor Christmas, and already the store sales and stocking are down, suggesting they're not expecting major Christmas sales. But I think that they'll be willing to talk a little bit more openly about the global slowdown, which is clearly here, and the United States slowdown, because it's going to say we need more stimulus, and that'll be the cover by which we move forward. And, John, the things we're seeing in the United States, the market going up, I contrast that, our European friends know only well their market is going through the roof right now. It's absolutely exploded. And I saw this chart I have up now in the Wall Street Journal the other day, and it's really really tells, and it shows the current account. I was mentioning that here a minute ago, current account in Europe versus the current account in the United States. Theirs has been fairly strong in spite of a 6-quarter recession. Flows of money relative to the United States have actually been going into Europe, as they've certainly been repatriated from the emerging markets. And the carry trade, you see it in the crosses, the euro-yen cross and in the yen index itself, as the yen has been devalued. And I have a chart of the amount of funds going into the European equity funds, and their chart here of the STOX 600 almost going parabolic. What worries me, John, is that what I learned from the emerging markets, the peripheral countries, and I have the chart up here showing net investment position with current accounts, that there's a bigger problem than what we saw briefly in Indonesia, Brazil, what I refer to as the faulty five, but in the peripheral Central and Eastern Europe countries, and Hungary right through Romania. We saw inklings of it in Cyprus. I think Europe could be the tipping point in here, is what I'm starting to conclude.
Yeah. Well, and European monetary policy is actually pretty tight. The euro is up lately.
Exactly.
And the European Central Bank's balance sheet is actually becoming less leveraged, and which is the exact opposite of what's happening with the Japanese and U.S. central banks. So these guys are moving in different directions in terms of policy. And so will that manifest as a slowdown in the European economy at some point? It might, and that might say bad things about their stock market going forward too. So we could see a stock market correction there that spreads here just as easily as vice versa.
And when it happens, what's the solution? Well, it's always the same thing. Pump more liquidity.
Yeah, central banks are going to increase the amount of currency in the system no matter what happens here. And the only question is what gives them the cover to do it. So we're really talking about a very narrow range of options and situations here when you think about it, because if there's some kind of a correction, that's their excuse. They will act as we all know they're going to act. They'll flood the system with even more currency, and that's going to have an effect on currency values going forward. So it's starting to look like a predictable world again, Gord, after a lot of mixed messages and competing scenarios and stuff like that. But the whole crack-up boom is starting to actually seem like it's probable now. Finally, there's something we can say, oh, yeah, I think that's going to happen in the next 2 years. And that's a big change over the last 4 or 5 years.
It's certainly something now to watch. John, we're up against our hard line. Great discussion. What is your conclusion? Dow 20,000 or Dow 5,000?
My conclusion is Dow down over the next year, and then very possibly up big from there, but not in real terms, only in nominal terms. If we have a big, long bull run starting in 2014, 2015, it'll be because the dollar is losing value faster than stocks are going up. So it won't be a good thing. It'll be a sign of very, very deep-seated serious problems heading for a chaotic crack-up. But it might for a little while fool people into thinking that things are actually okay. So it'll be a fascinating time that historians are going to look back on, write whole chapters about in books 100 years from now, and we get to live through it.
May you live in interesting times.
Yeah,
and
really.
we certainly are. John, can you tell our listeners how they could learn more about your views, or your ongoing views, and how your opinions, I'm sure, will continue to change and modify?
Yeah, I run dollarcollapse.com, which basically tracks all of this stuff on an updated daily basis.
John, thank you very much, and we'll talk again next month.
Great. Thanks, Gord.
Bye.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.